Hello everyone, this is Vignesh here. In this video, we are going to discuss a very important topic in accounting, that is the acquisition of business and the preparation of full-fledged financial statement after acquisition. First of all, I will clearly explain what is acquisition. It simply means that one company takes over the business of another. The company that sells its business is called the vendor company. The company that purchases the business is called the purchasing company. When one business acquires another, the accounting treatment is not just a simple transfer. We need to systematically close the books of selling company, known as the vendor, and prepare fresh statements for the purchasing company, also called the purchaser. This ensures that the new balance sheet reflects the actual assets, liabilities, goodwill, or capital reserve arising from the transaction. The consideration for acquisition can be in the form of cash, shares of purchasing company, debentures, or a combination of these. Now, once the agreement is made, two sets of account work must be carried out. The closing of the vendor's book and then the opening entries and preparation of financial statements in the purchaser's book. We will see a sum related to the acquisition of business. At 31st December 2024, the statements of financial position of Portosco and Sanasco were as follows. Here, the Portosco is a parent company and Sanasco is a subsidiary company. Non-current assets. Property, plant and equipment for Portosco is 56,600 and for Sanasco it is 16,200 and investment in Sanasco is 13,800. This is million, that is 13.8 million, 56.6 million, it is in millions. Current assets. Inventories for Portosco is 2,900 and for Sanasco it is 1,200. Trade receivables is 3,300 for Portosco and 1,100 for Sanasco. Cash 1,700 for Portosco and 100 for Sanasco. The total assets is value is 78,300 for Portosco, that is the parent company, and 18,600 for Sanasco, that is the subsidiary company. Equity. Share capital 8,000 for Portosco and 2,400 for Sanasco. Reserves 54,100 for Portosco and 10,600 for Sanasco. Non-current liabilities. In that, long-term borrowings 13,200 for Portosco and 4,800 for Sanasco. Current liabilities. Trade and other payables 3,000 for Portosco and 800 for Sanasco. On 1st April 2024, Portosco purchased 80% of holding in Sanasco for 13.8 million in cash. Sanasco's total comprehensive income for the year ended 31st December 2024 was 2 million, acquiring evenly over the year. Sanasco did not pay any dividends in the year. The non-controlling interest in Sanasco is to be valued at its fair value at 3.2 million at the date of acquisition. So, we'll see a detailed solution for this sum. First of all, we have to draw a group structure. Group structure. Portosco, the parent company, it acquired 80% of Sanasco on 1st April 2024 at 13.8 million. So we have to calculate the pre-acquisition reserve. So 13.8 million into 80%, it comes as 10.6 million. Second, the goodwill calculation. The consideration transfer, that is 13.8 million paid in cash by Portosco to Sanasco for 80% of share. Non-controlling interest at fair value 3,200, it is given in the question itself, less fair value of identifiable net assets at acquisition. Share capital of Sanasco is 2,400. Reserves 10,600 and 2,000, that is the total comprehensive income calculated only for the 9 months from April to December is 9,100. Overall, it comes the fair value of identifiable net assets comes at 11,500. So 17,000 less 11,500, the goodwill is 5,500. We have calculated goodwill and we have to disclose it in the non-current assets column. The third working is consolidated reserve. As per question, the Portosco's reserve is 54,100 and Sanesco is 10,600, in which reducing the pre-acquisition reserve of 9,100, that is we have calculated here, the post-acquisition reserve is 1,500. In that, the Sanesco's post-acquisition reserve is 1,200, that is 1,500 into 80%, 1,200. So by adding 54,100 plus 1,200, we will get 55,300. This is the consolidated reserve. The fourth is non-controlling interest. Non-controlling interest simply means that the parent co's unbought shares or unpurchased shares. NCA acquisition is 3,200. This is given in the sum itself. And the NCA share of post-acquisition reserve, that is we have calculated here 1,500 into 20%, it is 300. So the total comes as 3,500. So we'll create a consolidated statement of financial position as at 31st December 2024. Non-current assets, property, plant and equipment, totaling both the Portosco and Sanesco, it comes as 72,800. Goodwill is 5,500 calculated in working note 2. So total is 78,300. Current assets, inventories, both the Sanesco's and Portosco's total comes as 4,100. Trade receivables, including both Portosco and Sanesco, is 4,400. Cash, including both the companies, comes as 1,800. The total current asset is 10,300. Equity attributable to the owners of the parent. Share capital 8,000. Here only the parent share capital is taken, should be taken. Reserves calculated in working note 3 is 55,300. Non-controlling interest calculated in working note 4 is 3,500. So the total equity attributable to the owners of the parent is 66,800. Non-current liabilities, including both Portosco and Sanesco, is 18,000. And current liabilities, trade and other payables, including both the companies, comes as 3,800. So the total is 88,600. Here is the detailed explanation of the sum related to the acquisition of business. Thank you so much for watching this video.